Welcome to the Explainer. So today we're unlocking something pretty cool, the actual language of business. You see, every single day, countless real-world events happen inside a company. People are buying things, selling things, paying rent, earning commissions, and accounting is simply the art and science of translating all of those chaotic, real-world events into a structured, readable language.
Now, you might be wondering, how does a simple, crumpled-up receipt actually transform into a company's grand financial story? To wrap your head around this, I want you to think of accounting kind of like a giant, super efficient factory assembly line. We're going to feed raw data into one end of this factory, process it step by step, and watch it turn into clear, organized financial information on the exact opposite end.
Okay, let's dive into this. Here's our roadmap for today. We'll be hitting 1. The accounting process. 2. Source documents. 3. Types of accounts. 4. Those all-important golden rules. And finally, 5. Moving from the journal to the ledger. Let's get right into it.
All right, Section 1, the accounting process. It's basically a step-by-step cycle.
Think of this as the master blueprint for our factory. It's a continuous, highly organized loop that repeats in the exact same order every single accounting year. And as you can see, it perfectly maps out the complete life cycle of a transaction. We kick things off at Step 1, documenting the transaction. Because, let's face it, without proof, it literally didn't happen. Then, Step 2, we record it chronologically in the journal. Step 3, we post those entries into their specific ledger accounts. From there, we hit Step 4, whipping up a trial balance just to make sure the math actually checks out. And finally, Step 5, the grand finale, preparing the final accounts like the P&L and balance sheet. But for today's explainer, we're really just going to zoom in on those first 3 crucial steps.
Moving on to Part 2, source documents. These are our raw materials.
This right here is the absolute starting point. A source document, or a voucher, as you'll often hear it called, is the written documentary evidence that proves a transaction actually went down. We're talking cash memos, pay-in slips from a bank deposit, invoices, rent receipts, the whole shebang. These documents are the bedrock foundation of all accounting records. Whether they're cooked up inside the business or they flow in from the outside, the golden rule is super simple. No document, no entry. Period.
Next up, Section 3, types of accounts. This is where we sort all those raw materials.
Okay, so at the absolute highest level, the accounting universe splits everything into 2 main buckets: personal and impersonal accounts. Personal accounts, as you'd guess, relate to people or entities. The impersonal ones, they break down further into 2 really important categories: real accounts and nominal accounts. Honestly, if you can master this specific hierarchy, you can process literally any transaction that gets thrown at you.
Let's put some meat on those bones with a few concrete examples so it doesn't just sound like abstract jargon. Personal accounts are exactly what they sound like: people or organizations. That could be a real, living person like a debtor or an artificial person, like a bank or an insurance company. Real accounts, those are your assets, the tangible and intangible stuff you own. So cash, machinery, land, even goodwill or patent rights. And then we have nominal accounts. These just represent your expenses and your incomes. So paying salaries, that's a nominal expense. Collecting rent, nominal income. Simple as that.
But here is a really fascinating little quirk that trips people up all the time. What happens when a nominal account, say wages, isn't actually paid right away? Well, the trick is, when you slap a prefix or suffix onto a nominal account, it instantly morphs into a personal account. It's wild, right? So a wages account on its own is nominal because it's an expense. But if those wages are unpaid, it becomes wages outstanding. And boom, it's now a representative personal account because it represents the actual employees you owe that money to. Same thing applies to prepaid rent or unexpired insurance. It's a pretty brilliant feature of the system.
All right, Section 4, the golden rules of accounting. This is basically our Rosetta Stone.
This right here is your ultimate cheat sheet for the double entry system. You know the drill. Every single transaction has 2 sides, a debit and a credit. For personal accounts, the rule is debit the receiver, credit the giver. For real accounts, it's all about movement. Debit what comes in, credit what goes out. And for nominal accounts, it's about the end results. Debit your expenses and losses, and credit your gains and incomes. Lock these into your brain, and you can account for absolutely anything.
Let's actually put this into practice right now. Picture this. It's August 1st, and Khan starts his business with $150,000 in cash. I want you to think back to those golden rules we just talked about. Which 2 accounts are we dealing with here? Well, the business is receiving cash, right? And Khan, the proprietor, is providing the capital.
So based on our rules, what exactly comes in and what goes out? What gets debited and what gets credited?
Now, what's really cool is seeing how that theory translates into a proper formal journal entry. Take a look at that August 1st entry. Cash is a real account, and since cash is flowing into the business, we debit it for the $150,000. Khan's capital, on the other hand, is a personal account. Since he's the giver, we credit it for $150,000. Also, check out that brief little explanation in brackets right underneath. That's what we call the narration. It basically guarantees that anyone looking at the journal knows exactly what went down without having to play guessing games. And remember, this journal is known as our book of original entry.
Before we move on from the journal, I've got to show you a quick factory shortcut. It's called the compound journal entry. Sometimes you get 2 or more transactions of the exact same nature happening on the exact same day. So instead of writing out a tedious separate entry for every single one, an accountant can just pass a combined entry. You might have one account debited and multiple accounts credited, or vice versa. Honestly, it's a huge time saver, and it keeps the journal looking incredibly clean.
Moving right along to Section 5, Journal to Ledger. These are our final storage bins. Let's see how all this builds together. We've documented our transactions, and we've recorded them chronologically in the journal. Now we gotta sort them out. Enter the ledger, which is also known as the principal book of accounts. If the journal is just a running timeline of everything that happened, day by day, the ledger is where we organize everything into specific account bins. Taking info from the journal and putting it into the ledger, that's an action we call posting. Each account gets its very own page in the ledger, neatly split right down the middle. The left side is your debit side, and the right side is your credit side.
So understanding the difference between these two books is absolutely crucial. The journal is your subsidiary book. It's just a chronological day-to-day timeline, complete with those narrations that tell the story of each entry. But the ledger, that's your principal book. It's totally analytical. It strips away all the narrations and just groups the related transactions together. Think of it this way. If you want to know exactly how much cash you have on hand, you are definitely not going to read the journal line by line. You're going to flip straight to the cash account in the ledger to check your net balance.
Think about the journey we just took. We turned a messy, scattered pile of source documents into a strict timeline of debits and credits, and then we neatly sorted them into highly organized, analytical ledger accounts. But that leaves us with one pretty provocative question. If the journal captures the timeline and the ledger organizes the categories, what story do your financial books actually tell at the end of the year? I mean, are you actually profitable? Are you sustainable? To figure that out, you've got to verify those debits and credits with a trial balance and ultimately build out your final accounts. But hey, that is a whole other story for our next explainer. Thanks for jumping on the assembly line with me today.